Ladies and gentlemen, good day and welcome to Tyre Industries Q3 FY24 earnings conference call hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Jain from Emkay Global Financial Services. Thank you and over to you, sir.
Thank you, Aditya. Good evening, everyone. On behalf of Emkay Global Financial Services, I would like to welcome you all to the 3Q FY24 earnings conference call of JK Tyres. Today we have with us from the management team, Mr. Anshuman Singhania, Managing Director, Mr. Arun K. Bajoria, Director and President, International Operations, Mr. Anuj Katuria, President, India Operations, Mr. Sanjeev Agarwal, Chief Financial Officer, and Mr. A.K. Kinta, Financial Advisor. I shall now hand over the call to the management for their opening remarks, post which we'll open the floor for Q&A session. Over to you, sir.
Yeah, thank you. On behalf of JK Tyre and the family, I wish you and your families a very happy new year 2024. It is an immense pride I share with you that all financial year 2024 so far has been very noteworthy achievements in our businesses. Amongst many, JK successfully completed its QIP of rupees 500 crores, which received an overwhelming response from the marquee investors, reinforcing confidence in our growth story. This is in addition to 240 crores raised from IFC Washington in March 23 by way of preferential issues. Talking about Q3 FY24 performance, JK Tyre continued to pursue profitable growth centered on product premiumization, volume expansion, and improved product mix. Q3 witnessed a significant improvement in operating profitability and achieved an EBITDA of rupees 563 crores on a revenue of 3,700 crores. The net debt at 3,456 crores registered a 24% reduction from the levels recorded in March 23. Return ratios have also improved significantly over March 23. Strong momentum in the economic activity and positive consumer sentiments across product categories continue to provide tailwinds to both automobile and tire industry. In Q3, JK Tyre has clocked a volume growth of 7%, mainly contributed by replacement and OEM segment, which grew by 11% and 6% respectively over the corresponding quarter. However, export has seen a volume reduction of 8% due to geopolitical disturbances and supply chain disruption. The ongoing capacity expansion projects for TBR and PCR are progressing as per schedule, and full production ramp up will be achieved by end of FY24. We have further announced an implementation of capacity expansion in TBR, PCR and all steel light truck radial tires for an aggregate cost of 1,400 crores. Recently, JK Tyre hosted its 19th edition of Indian Tire of the Year and the Indian Motorcycle of the Year Awards 2024. The most coveted and prestigious award in the Indian automobile sector, a platform created by JK Tyre. CV segment continued to witness high single-digit growth with demand supported by government impetus on infrastructure, mining and construction, growth in core industry and rising tourism and sustained growth in the e-commerce activities. The PV segment growth trajectory continued for 2 consecutive financial years with introduction of new models launched and positive sentiments towards SUVs. The PV sales growth momentum is expected to continue going forward. On the tire sector outlook, demand momentum continues to be steady in the domestic market. We remain optimistic for the tire sector in the medium to long term. The demand is primarily driven by private sector capex, high vehicle utilization, increased disposable income, and its mentioned earlier impetus on infrastructure development. On export outlook, the global environment continues to remain challenging as the supply chain disruptions has erupted on account of Red Sea crisis, which has increased the ocean freights. However, the demand is on a recovery trajectory in the global market. On the channel development, during the quarter, we added 35 brand shops and 40 plus fleet customers to enhance our brand presence in the replacement segment. We are continuously growing our network in identified white spaces. We have further strengthened our presence for supplies of XM, XF and XD series tires in the e-buses and the CV models across OEMs. Our thrust on increasing R&D spend will further enhance our range of innovative products in the portfolio. Focus on ESG is one of our key strategic priorities. We are investing in renewable energy at all our plants to become more sustainable. We are committed to deliver strong operational and financial performance with a focus on growth plans. The same will enable us to deleverage the balance sheet further and enhance stakeholders' value. Now I would request Shri Arun Bajoria ji to talk about the performance of JK Tornel, Mexico.
Thank you, MD sir. On JK Tornel, Mexico, in Q3 FY24, JK Tornel, Mexico displayed resilience, sustaining robust performance in both overall revenue and profitability. Despite the challenges associated with the lower number of working days, typical of the third quarter, being December being a Christmas month, Tornel achieved a turnover of 1,291 million pesos, which is equivalent to rupees 620 crores, maintaining stability on a year-on-year basis. Operating profits at EBITDA levels remained slightly lower at 102 million pesos, equivalent to rupees 49 crores, showcasing the company's consistent financial strength. Notably, JK Tornel retained its leadership position in the Mexican PCR market, enjoying the highest market share among all the Mexican tire manufacturers who are even foreign companies but manufacturing in Mexico. To further strengthen its market presence, the company is actively gearing up for the launch of new brand of PCR tires. Earlier, the performance was affected by the continuous appreciation of the Mexican peso, impacting exports. However, the gradual increase in private consumption in Mexico, coupled with positive per capita income growth, is fostering a supportive environment for domestic demand, a trend expected to persist in the coming quarters. We actively participated in the world's largest tire exhibition, the SEMA show, held in Las Vegas during Q3 of FY24. The positive response received from customers at this event underscores the company's strong market position and customer satisfaction. Now, I would request Shri Agarwalji to brief about the financial performance of Q3.
Thank you, sir. I will briefly share the key highlights for Q3 FY24. The first one is the consolidated sales were recorded at rupees 3,700 crore, vis-a-vis 3,623 crore in Q3 FY23, which is up by 2% on YOY basis. Profit at EBITDA level in the quarter was recorded at rupees 563 crore as against rupees 349 crore in the corresponding period. An impressive increase of 61% on YOY basis. Operating profit margins were recorded at 15.2% on consolidated basis. Operating margins were sustained during the quarter despite some increase in raw material prices. Cash profits doubled to rupees 456 crore during the quarter. Profit after tax was rupees 227 crore, more than 3% increase on YOY basis. Three times increase on YOY basis. Sorry. Consolidated capacity utilization was 85%. Consolidated exports stood at rupees 570 crore, which is slightly lower than the previous corresponding quarter last year. Subsidiary companies Cavendish Industries and JK Tornel, Mexico, continued to perform well and have contributed significantly to the revenues and profitability on consolidated basis. Cavendish Industries Limited posted a top line of rupees 900 crore with EBITDA at rupees 140 crore, registering an operating margin of 15.6% and profit after tax was rupees 50 crore. Earnings per share improved to rupees 8.52 per share as against rupees 2.66 per share in Q3 last year. Return ratios have significantly improved. ROCE and ROE were in high teens. Pre-tax ROCE was 19.7% and ROE was 19.4% respectively. Net debt stood at rupees 3,456 crore as on 31st of December 23, which is lower by 24% over March 23 levels. Leverage ratios improved significantly over March 23. Net debt to equity improved to 0.75x in Q3 FY24 as against 1.29x as at the end of March 23, and net debt to EBITDA improved again substantially to 1.72x in Q3 FY24 as against 3.39 as at the end of March 23. The balance sheet of the company is now much healthier with improved financial ratios, and we have circulated our earnings presentation, which is available at our website as well, on the website of stock exchanges. Now we open the forum for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Aditya Agrawal from Omkar Capital. Please go ahead.
Yeah. Hi, sir. What is the revenue mix by market for India operation for the quarter?
Revenue mix of the India operation. One second.
Yes.
In India operation, the replacement market for the India operation Q3, it is 61%, OEM is 26%, and export is 13%.
Okay, thanks. And what is the revenue mix by product line for India operations for Q3?
Truck bus, which includes truck bias and truck bus radial, it is 62%. Passenger line radial, 23%. Two three-wheeler is 5%, and non-truck bias is 11%.
Okay, thank you so much.
Welcome.
Hello. Our next question is from the line of Aditya Rathi from Equities Investment. Please go ahead.
Thank you for the opportunity, sir. Sir, we see that the sales has grown only 2% YOY. So I just wanted to know the volume change.
So the volume has grown from the corresponding and consolidated 6%.
This 6% is YOY, right, sir?
Yeah. Our third quarter corresponding to the third quarter last year.
Right. And sir, QOQ? Hello?
One second. QOQ consolidated is 5% growth.
5% growth. And sir, what about the coming quarters? What do we expect?
Sorry, the Q quarter on quarter is negative 5%, not plus.
Right, sir. And sir, going forward, what are we expecting, sir, in terms of volume?
We are very optimistic on our outlook in terms of the growth in the market, which is led by the infrastructure growth. There is a lot of positive sentiment going forward, be it the replacement market and the OEMs. And we are seeing that we should participate in that momentum of growth. Private sector capex, as I read out, is coming back, the capex cycles, and higher vehicle utilization is also helping us. So we are seeing in the range of 6 to 7% volume growth going forward.
I could not hear you. There was a crack in the voice.
I'm sorry, I can't hear you properly.
So Anshumanji mentioned that there will be
Hello?
a 6 to 7%. Hello, can you hear us?
Hello, Aditya sir. Can you hear? Hello. I think the line from Aditya sir has been disconnected.
Okay, I think his question was that what is the kind of growth we are expecting. So I think Anuj mentioned that 6 to 7% volume growth we are expecting going forward.
Okay, perfect.
Sir, should I proceed for the next question?
Yeah, please.
Our next question is from the line of Chirag Jain from MK Global. Please go ahead.
Sir, I had a couple of questions broadly in terms of the capex that we are doing and also the upcoming capex that we have already announced. Bulk of the capex is happening on the PCR side. and that's a fairly significant capex that we are incurring. So can you just throw some light and so just to understand or get some more visibility in terms of how we would be ramping up, let's say, business on the PCR side, gaining market share. In fact, last 5 years we have been gaining, even let's say this year so far we have been gaining, let's say, profit pool compared to the other tire companies that we have so far that they have delivered results. So some confidence, if you can, or let's say some comments with respect to the marketing side, distribution side, apart from the capacity increase that we are doing on PCR, how we can ramp up the operations over here.
So as you know that we are already we are going to be completing our announced capex by FY23 24, and further to that we have announced 1,400 crore capex, which is in the category of TBR and PCR and all steel radial as well. So we see that market for us, we should participate in the growth, in the growing market. In Q3, the domestic volumes, we witnessed a 7% growth over the corresponding quarter. Replacement market volume grew by 11% and OEM volume grew by 6%. So as earlier question, we are seeing the market growth nearly 6 to 7%. So these earlier announced capacities are helping in participating in the fueling growth. Plus our play of premiumization has also helped in terms of better profitability. So going forward, as we are reaping the benefit of the new investments also which are going to come in, we are going to be definitely participating in the growing market.
Okay, so apart from the growth, since bulk of the growth would be coming from PCR, which I believe is far less margin accretive compared to the company average, do we see an upward bias on margins from a 2-3 year standpoint? I understand there could be quarterly fluctuations because of commodity swings, but from a 2-3 year standpoint, do you think there is an upward bias on margin profile?
You see that our new capex is being in the radial line, and as I said that PCR and truck radial and all steel, they are all high margin products, and this is going to be adding ultimately high profitability. So as we go along, the high margin products are going to be enriching our product mix. Yes, going forward, some of the vagaries in terms of commodity prices or in terms of any price fluctuations will also insulate us to some extent of these vagaries, because we will be participating in the higher profitable, higher rim sizes and enriching our product mix as we are going along.
Okay. And just last thing before I come back in the question queue, in terms of debt reduction, it has been quite fast over the past few quarters. How do we see next 2-3 years the overall debt equity position, sir?
Sanjeev,
Chirag,
you want to take this?
Yes, sir. So Chirag, in fact, what we are seeing that there is a very rapid reduction in the last few quarters, which we have been able to achieve through efficient working capital management and the kind of equity which has been coming into the company. Over the last 9 months, in fact, we have raised about 740 crore rupees, which is mainly for the purpose of capex and the projects announced. But going forward also, because of the increased profitability, and also we have taken up these projects in phased manner, so we do not see any increase in debt levels from the present one. And the debt to equity will remain in the range of about 0.5 to 0.7, which is today at 0.75. So we are expecting this to be there. And also debt to EBITDA, as we are seeing that the margins will sustain or rather improve further. So the debt to EBITDA will also improve further. And today, as I told you, that we are at 1.72. So we are hoping that this will remain in the range of 1.5 to 1.8 in spite of the fact that we are going ahead with some of the expansion projects, which will contribute, of course, to the greater profitability and the revenues. And therefore, the margins will improve and this debt levels will remain within a very tight range. And also, we have been repaying almost about 400 crore rupees of debt every year. So, keeping in view all these facts, I think we would be in a much better situation going forward.
Okay. Thank you so much, sir, for the detailed answer. I'll come back in the queue.
Because on the one hand, profitability is going up. On the other hand, we have raised equity. And on the third hand, the working capital management is being properly utilized so that the total borrowings are less. So financially, I think we are in a very happy situation at the moment.
Yes, thank you. Thank you so much, sir. I'll come back in the queue.
Thank you.
Thank you.
Thank you. Our next question is from the line of Bharat from Living Root. Please go ahead.
Yeah, hi. I would like to ask that, Anshumanji, you were saying that, we are scheduled to complete all our CapEx programs by FY24. So what will be the peak revenue potential as per the CapEx programs once the CapEx programs are complete?
The earlier CapEx plan which was announced, so that is around 800 crores. That will commence, which is progressing well. That will commence by quarter 2 FY24, and we are looking at 18 to 19,000 crores.
So this is a mix of, quarter 2 FY25, I think you were saying, by June, July of this current year, right? July, August of this current year.
In fact, what Anshumanji is mentioning is that the production has started out of the latest projects which we have completed, and the ramp-up is happening. And
right.
With the kind of capacities we have built up, the complete ramp-up, let's say in the first quarter, we will be achieving of the financial year FY25, and then we will be in a position to achieve 18 to 19,000 crore rupees of revenue.
Okay. So meaning the ramp-up will already, so you're saying the production is already started and then ramp-up will happen. So
yes,
ramp-up
is happening at this point in time.
Okay. And you see that much demand, to sort of do that much revenue? Because I think in this quarter, I missed the first initial part of the call, 5 minutes.
Yes.
So I think the revenue growth compared to last quarter in September was slightly lower. So if you can just touch upon the reason again, please.
No, this is actually as per the studies conducted by CRISIL and other such agencies. There is a growth of about 6 to 7% in the tire sector, right? And this is likely to continue over the long period of time. And on quarter-on-quarter basis, if we see that could be a slight reduction, but overall Indian volumes have gone up. So, for example, as we mentioned earlier, replacement market has grown already at that pace. And
JK Tyre, in terms of the volume growth for the quarter 3, has been an overall 7%, where replacement grew by 11 and OE grew by 6%.
Okay. That's correct. Okay. So we are expecting the growth in the industry to be to continue in the long run, and there could be some reason of, let's say, some disturbances geopolitically in the export market or maybe in the international business and all. So, but those are very temporary in nature.
Okay. So one more thing, I think on the raw material part, of course, crude is, you have already mentioned, Sanjeev ji and others also, that, crude you are comfortable up to level of $85 a barrel. Right. But if you talk about the other major component, that is natural rubber, so that price in the last few months have gone up. I mean, from like 140 to around 160, 65 now. So what role does that play? Because that is also a decent component of your raw material basket, isn't it?
So as we mentioned earlier also, that we have been actually ring fencing the margins, and margins in the range of about 13 to 15%, and there could be some fluctuation in one raw material or the other in the basket, but that is not likely to impact the company's profitability, because we will be in a good position to pass on a large part of it. Could be with some lag or lag effect. But I think we are good to go with, as long as the demand is there, and because we are expecting a good demand increase growth going forward. So the margins will be maintained in a healthy range of about 13 to 15%.
Okay. And I think one final question, if I can just squeeze in for Mr. Katuria, that how do you see the CV cycle right now? Because I think this year is expected, the current financial year, that's FY24, we're seeing the highest ever sales of CVs. So going ahead, what's your outlook on the CV industry? Hello?
I think he was on the line, Mr. Katuria, but I think there is some reception issue. But to take that question, the understanding is that CV market, yes, you are right. CV market, we are seeing some sluggishness, but this is going to be very short term. As the economy is also fueling up and the core sector growth is coming in, we're seeing that CV cycle market and the demand coming back. But it is not going to drop that much. It is going to be at a stable level.
Okay, sure. Thank you, sir. Thank you, and all the best.
Thank you so much.
Thank you. Our next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Sir, thank you for opportunity and congratulations for a very strong EBITDA margin performance vis-a-vis peers. So first question is on volume growth. When we are indicating 7% growth, am I audible?
Yes.
Yeah. So 7% volume growth is for Q4, or going forward even 25-26 will witness similar growth? And on that only, in case if we are assuming 7% growth and OEM, CV as well as tractor sales are coming down on a YOY basis, so that means OEM growth would be more or less flat or marginal growth. That implies that replacement growth should be 12-15% type of number. So is that assessment right, sir?
They do all weekly forward. Investor.
This is...
Hello?
Yes.
No, can you please repeat your question?
Your question is finished?
Yes.
Yeah, so there has been a 7%. We witnessed a volume growth of 7% in Q3, and here the replacement volume grew by 11, and OEM grew by 6%. We see that momentum continuing for the next quarter as well. But going forward, there could be some slight volume growth which might come little lower in the OEM because of the sluggishness in the truck space. But the overall, we maintain that 6 to 7% the automotive will definitely grow. And please also don't forget that this growth of overall 7% has also come at that quarter of October, November, December, where there is always a new year and there is always a model change and etc.
So that means replacement growth will continue to remain in double digit, right?
Yes, absolutely.
So second question on debt side, when we are saying our debt will not increase from this level, so sir, broader calculation is that we are saying 1400 crore capex for next 2 years. We already have 700 crore kind of a cash at balance sheet, and nearly we are generating 1500 crore cash flow every year now based on the current last 3-4 quarters performance. So that implies that out of almost 3,000 crore operational cash and 700 crore on balance sheet, we would be able to reduce our debt by more than 1,000 or 1,500 crore in next 2 years. So why we are saying that it will be more or less in the similar range?
Sanjeev?
No, so overall the debt today, which is as at 31st of December, was about 3,500 crore overall on net debt basis. So which is going to go down further as we are expecting and estimating better cash flows going forward with increased revenues and increased profitability. And because today we have taken up some of the projects, so new loans will come in, but the repayment is also happening at the same time. And we will be rather in a better situation to reduce the debt going forward. But I am saying that in case some more projects are taken up going forward, then the broad levels of the debt to equity will be in the range of 0.5 to 0.7% still.
However, the new project will depend on the market demand and the conditions, no?
Right. But as of now, we see that the debt levels will go down further at a very fast pace.
Okay, sir. Lastly, on this Mexico operation, we are hearing that in US or North America may increase tariff on all the imported tires. So is there any update on that? And in that case, can we ramp up our Mexico operation to capitalize this benefit? What is the utilization and potential in that plants in terms of increasing manufacturing?
At this point of time, the utilization level is around 81%, and therefore we have some possibility to increase the capacity utilization, and we are planning accordingly. And there is no question of reduction of the export quantities from Mexico to US.
Yeah, sir. Thanks, sir. Thanks a lot and all the best.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask questions. Our next question is from the line of Aditya Rathi from Equities Investment. Please go ahead.
Thank you again, sir. Sir, I just wanted to know how this capex of 1,400 crores will phase out, and when do we plan to start the commercial production of it? Second quarter.
So the new capex of 1,400 crores will commence by Q3 FY26.
Q3 FY26. Hello.
Yes.
You mentioned Q3 FY26, right?
Yes.
Okay. And sir, last question, sir. I wanted to know how the raw material basket has moved from last quarter to this quarter, and what do we expect it going forward?
So we have the quarter on a quarter basis, the raw material price increase has been in the tune of 2%.
Okay. Do we expect it to be stable here, or do we expect any movement or staggering huge?
No, we see that raw material prices will remain range bound in the quarter 4 FY24.
That's it from my end. Thank you, sir.
Our next question is from the line of Shashank from ICICI Securities. Please go ahead.
Yes. Hi, good evening, sir, and thanks for the opportunity. Sir, need just one small clarification on the capex part. So we were already executing 1,100 crores of capex before, and the last quarter we announced 1,025 capex, putting together 2,200 crores of capex plan. So this 800 and 1,400 are part of the same plan, or this is some incremental capex that is supposed to do?
This is incremental capex. This is for mainly the PCR, and this is an incremental capex because the earlier expansion which we were implementing for 530 crore for PCR, That has already been completed. The ramping up is happening for production increase. So that has already been completed, as we have discussed earlier also, and this is an incremental CapEx for the PCR. And for others also, we have announced 261 for TBR and 112 crore for the all-steel radial tires, for all-steel LTR tires, light truck radials.
Right. So starting FY23 till 26, so this 4-year period, what is the entire CapEx spend, the growth CapEx spend?
So as we said, 790 crore rupees has already been completed, and the production ramp-up is happening, and then we will be implementing 1,400 crore rupees of expansion CapEx.
2,200 odd crores, right?
Sorry?
In total, 2,200 odd crores.
Yes.
And we will be spending something like 250 crores of maintenance CapEx each year as well.
That's correct.
Right. So then, in terms of cash flow outflows, how do we see the CapEx outlay for this year and next year in terms of the CapEx spend?
So, I think we have discussed already. We have been implementing these projects in phases and over the next 2 years period. So, this fund for the funding of these CapEx will happen through a mix of debt and equity. The equity part is already raised of about 500 crore rupees recently, and the balance will come from internal accruals and the debt.
Yes. But from a cash flow perspective, then eventually we should be spending like 1,000 crores each year, right? 24, 25, 26.
Including the normal CapEx of rupees 250 to 300 crore rupees. That's correct.
Right, sir. Right. Understood, sir. Thank you so much and wish you all the best.
Thank you. Our next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Sir, thank you for follow-up opportunity. Sir, one clarification when we told that revenue potential of 18 to 19,000 crore, that is including this 800 crore capex only, or we consider this 1,400 crore capex post that potential goes to 19,000 crore?
Actually, that is only with the existing projects which we have recently completed, and the new capex which will come in only in quarter 3 of FY26. So that is not included in this.
So after that, what could be revenue potential, including that 1,400 crore capex, maybe after 2 years?
1.1 to 1.2 ratio of asset to turnover. I think we will add another maybe about 1,600 crore rupees.
Okay, sir. And second, on Cavendish, sir, we are already now at a 15.5, 16% type of EBITDA margin. So is there any further scope for improvement in margin with the utilization or product mix, or this is the optimum level for Cavendish now?
Beyond 15.5, which we have achieved in Q3.
Yeah. So actually, if you see, we have been working on premiumization and improving our product mix. So that exercise will continue. But also we have seen that there was an impact of 2% on raw material prices. So if everything were to be favorable going forward, definitely there will be an opportunity to improve the margins further on operations. But we also need to keep in mind that some of the other, as Sanjeev Agarwal earlier explained, that the raw material basket, some of the components of the raw material basket may be volatile. So we will have to watch those carefully, both in terms of crude as well as in terms of natural rubber. So in case those turn out to be favorable and our efforts on premiumization also are going to be giving us the results, then yes. Otherwise, as we say, for our industry, it is at 13 to 15% is something which we expect, which is a stable guidance that can be taken.
Sir, lastly on Mexico operation again, this quarter was Q-on-Q sequentially slightly weaker. Anything one time, any specific thing, or going forward, how we expect performance in terms of volume as well as margins?
Well, going forward, the revenue should be improving And the markets, of course, we are expecting them to be better. As I had said earlier, that our capacity utilization in 2024 is expected to be better than 2023.
But nothing one specific for Q3 in terms of number of days or holidays or anything?
No, Q3, as I said, that, 17 days of December are lost due to the Christmas holidays. So therefore, as I had said in my opening remarks, that the Q3 is affected because of the lesser number of working days.
Understood, sir. Thanks, sir. Thanks a lot.
Thank you. Our next question is from the line of Rahil Shah from Crown Capital. Please go ahead.
Hi, sir. Good evening. How was the MHCV demand in quarter 3, and how is it likely to be in quarter 4?
So when you're talking about M&HCV demand, the OE, from the OEs, the demand was sluggish, I would say. It was almost flat as compared to the earlier quarters. So there we are seeing that quarter 4 is generally a good quarter. So we expect that the demand should come back in quarter 4. Although, we have to watch this very carefully, because as we know that the M&HCV is in the overall commercial vehicle is cyclical, but M&HCV has the largest amplitude in cyclicality. And last 2-3 years we have seen that there is an upcycle. So we have to wait and watch that where are we on the cycle. Are we kind of flattening out, or is the upcycle going to continue? One thing which I would like to definitely say, that buses are doing very well. In fact, the demand for the bus tires is quite robust, especially the tubeless radials. And also the demand in the mining and construction, that is also holding up quite well. And we hope that the infra push that is there from the government will continue. So that also should help us generate the demand. But when we look at the replacement market, I think so the replacement market, the demand is quite good as of now also. And we expect that going forward it will continue to remain robust for the tires in the replacement market.
Okay. And this 13 to 15%, you said sustainable margin steady state. You meant for a specific business arm or on console level, you said, for Q4 and going ahead in the next year as well?
No, this 13 to 15% we said was on a longer term basis, on a steady state. But we will have to see. One of the major things that we have to watch very carefully is the raw material basket.
Right, okay. And can you just give me the JK tonal revenue this quarter?
This quarter we mentioned 620 crores. I converted the peso millions into rupees.
Okay. And sharing any guidance for next year, revenue growth?
We are working towards improving this revenue going forward in 2024.
All right, sir. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Chirag Jain from Emkay Global. Please go ahead, sir.
Sir, just had one question with respect to the competitive scenario, because growth has somewhat been slow in the current quarter, and even RM is also stabilized. Any signs of discounting or price cuts or any major sort of a competitive action that we are seeing in the market in general? Any thoughts around that?
Chirag, Anuj here. So basically, you're asking about the pricing. If you can see is that when the raw material costs are going up, we had actually taken a lot of price increases, and we were able to pass on most of the impact of the raw material that was there into the market, although it happened at a lag. But in this year, we have seen that the raw material prices have been rather range bound. We saw a marginal increase of 2% in between quarter 2 and quarter 3, We expect that going forward, this will be there. On the pricing front, it is very difficult to give you a very straight answer for the simple reason that every segment plays out differently. And within the segment also, we have now worked on premiumization. So there are certain niche SKUs, what we call as the power SKUs, where we have taken certain price increases. But in general, we are trying to see that, finally, the pricing is a function of the supply and demand in the marketplace, the market forces. So segment to segment, SKU to SKU, the team navigates. But overall, if you see, is there a reduction in the overall price or the NSR? I think so. It has been more or less in the same range. SKU by SKU, there have been certain variations.
Okay. So broadly, the market is fairly stable from a comparative landscape perspective. No major change per se. Yeah.
Yes.
Okay. Thank you so much.
Thank you. Our next question is from the line of Bharat from Living Root. Please go ahead.
Yeah, hi. I just missed one question. I wanted to ask regarding the tax rate. So in the previous quarter, you had mentioned that from the next year, we are moving to a 26% tax rate. So we are still on track for that?
Yes, we are very much on track, and we will be consuming the entire MAT credit available in this financial year. And we will move forward. From next year onwards, we will be moving into the new regime.
Okay. I think that's the only question I have. Thanks.
Thank you.
Yeah.
Thank you. As there are no further questions from the participants, I now end the conference over to management for closing comments.
Okay. Thank you so much for joining this conference call, and I wish you all a good year ahead. And thank you very much.
Thank you.
Thank you very much.
Thank you. On behalf of Emkay Global Financial Service, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.